In Chapter 24, we look at variance analysis. So what are the differences between our actual results and our budgeted results? And then that flexible budget that we talked about in Chapter 23. So that flexible budget is our actual quantity at our standard budgeted amounts. So we're going to look at materials, labor, and overhead variances. So for this example, we're going to start with the materials price variance. With materials price variance is a comparison of what we actually paid for our materials versus what we budgeted to pay for our materials. So we take the actual number of materials used. We can see here that we actually used 102,500 pounds. So 102,500 times, and then the difference between what we paid and what we budgeted. So we budgeted 60 cents per pound, and we paid 57 cents per pound. So our materials price variance is $3,075. We saved 3 cents a pound versus what we budgeted. That is a favorable variance because we saved money. Our quantity variance is how much should we have used versus how much did we actually use. We already know we actually used 102,500 pounds. How much would we have budgeted to use? So we have that we budget 500 pounds of materials per batch, and we made 200 batches. So our budgeted materials quantity is 500 pounds per batch times 200 batches, or 100,000 pounds. We used more than we planned to. So we take the difference, what we plan to use minus what we actually used, times our budgeted cost of 60 cents per pound. So our materials quantity variance is $1,500, unfavorable. We used 2,500 more pounds than we had budgeted for our level of production. Our total materials variance is the sum of these two added together. Overall, it's a positive variance. Because of that 3 cents a pound savings, in general, we had a positive materials variance. Our labor rate variance and efficiency variance are calculated very similarly. So our labor rate variance looks at what did we actually pay versus what did we budget to pay. So we take our actual hours of direct labor hours. So we have up here that direct labor actual hours were 4,750. Then we look at the difference between what we budgeted and what we paid per hour. So we budgeted direct labor at $7 per hour, but we actually paid $6.80 per hour. So we have a $950 labor rate variance. Because we paid 20 cents less per hour than we had budgeted, this is a favorable variance. Now for our efficiency variance. For our efficiency variance, we have to know how many labor hours we budgeted for. So what we know is that we budget 25 hours per batch. And we made 200 batches. So 25 times 200 equals 5,000 labor hours. So we budgeted 5,000 labor hours and actually used 4,750. Our standard rate of labor is $7 per hour, and that is times the difference between what we budgeted and what we actually used for direct labor hours. Our labor efficiency variance is a positive variance. We used less labor hours than we budgeted, so we were more efficient with our time. Overall, our total labor variance is positive. Now we're going to look at the spending overhead variance and the volume variance. So the spending overhead variance is the difference between the actual amount of overhead we paid and our budgeted overhead. So if we look at our budgeted overhead, we have fixed overhead of $5,000 per month. So, or $50,000 per month fixed overhead, plus we have a variable rate of $25 per batch, and we did 200 batches. So 25 times 200 equals, so we have 5,000 in fixed overhead and 50,000 in fixed overhead and 5,000 in variable overhead. So our total budgeted overhead is 55,000. Our actual overhead spending, 54,520. So our overhead spending variance is 55,000 minus 54,525, or $475. We spent less than we budgeted, so that is a favorable variance. Our volume variance is the difference between the applied overhead and our budgeted overhead. So we already have our budgeted overhead at $55,000. Our applied overhead is our overhead application rate of $225 per batch times the 200 batches that we made. So the applied overhead was 45,000. So our volume variance is 45,000 minus 55,000, or negative $10,000. This is an unfavorable variance. The volume variance is caused specifically by us doing a different level of volume than we budgeted. We had budgeted for 250 batches. We actually made 200 batches. So our total overhead variance is an unfavorable variance of $9,525. Next, we would calculate our journal entries. So first we have our direct materials journal entry. So we move direct materials to work in process inventory when we're working on production. Our direct materials cost, it tells us, were $58,425. However, we record in our work in process inventory at our standard rate. Our standard rate for direct materials is 60 cents per pound at our budgeted materials quantity. So 100,000 times 60 cents. Now we need to record those variances. So if we have an unfavorable variance, we are going to debit that. And when we have a favorable variance, we credit that. So we have our materials quantity variance, $1,500, and our materials price variance is $3,075. We do the same thing for our direct labor. So our direct labor recorded our actual cost of $32,300. Our work in process inventory is our standard or budgeted amount. So this is our 5,000 hours of budgeted direct labor times our rate of $7 per hour, or 35,000. Then we have two favorable variances. We have the labor rate variance of $950 and our labor efficiency variance of $1,750. And last is our overhead. So our actual expenditure of overhead was $54,525. Our applied overhead is $45,000. And then we had a volume variance of 10,000 and a spending variance of $475.